Hey guys, we're back again. It's Randy Hatada, broker at Xpand Realty. Special guest Dax Tobin from Millenium Mortgage. And last video we put out there basically what was going on with the Fed hike and some housing and market updates and some of the things that we're seeing in our industries. And on the last video, we had promised that we would be talking about how to better your interest rate, potentially if you're buying, or how to use it as a strategy in order to sell your home. And so today we're going to engage that, and then we're going to go into more of the details from the lending side, and Dax is going to share some insight about how that affects your loan and interest rates directly, and I'll be talking more on the buyers and the listings itself. So Dax, how you doing today?
Good.
Yeah.
How are you? Yeah, thanks.
Pretty good, pretty good. It's a happy hump day, and there's a lot of change going on in the world, as you know, and it's happening at the speed of light. We were prepared for it, luckily, but here we are, and it happened in less than a month.
It did. It was a very quick reversal.
So how's your lending world going today?
It's a challenging market right now, but this is why we come up with strategies like this to help overcome some of those challenges, and tactics and strategies to help both buyers, sellers, realtors, everybody, make sure that they get what they need.
I think the biggest challenge right now is consumer confidence and buyer confidence, and based on, in my opinion, it's a lower confidence based on the information they're getting and where they're getting it from. So why we're here today is to make sure you get the accurate information so you can make a decision on whether it's the right time for you to buy or wait, or right time to sell or wait, or rent, or whatever that option may be. But we're here to give you the data to make that good educated decision. So last conversation we talked about interest rate buy downs, and really what's happening is the fact that interest rates are higher than they were yesterday and a year ago and so forth. Maybe not yesterday, but in the recent times. And we went down into the high twos, is that right?
Yeah.
At a low, but that was a historic low, guys. You got to understand that when we hit the twos, that was probably the all-time low in all of the U.S. history of interest rate, mortgage rates.
Correct.
Yeah, so very spoiled because we're coming from the historic low. Today, what are our average interest
High
rates?
fives.
High fives. So with that, I remember in 2006, our last market high here in Las Vegas, that high fives was a great rate, and we were ecstatic to get into the fives, right? So now that we're here today and we're a little bit spoiled, it's a shocker, and it's led buyers to pause and potentially sellers to not all panic, but get really concerned about what's really going on. And based on the fact that buyers lack the confidence in general in putting the offers out there today, and to clarify, the buyers are here, guys. People are continuing to move to Las Vegas. They're just trying to figure things out and figure interest rates out and look for some kind of consistency or stability, because right now everything's volatile. So we have a lot of buyers that kind of look like deer in the headlights. Are you seeing that on your side?
Yeah, I mean, uncertainty is what is the most concerning for people. When people have clarity on what's going on in the markets and in their lives and everything else, they act. They make decisions, and when they're uncertain about things, it leads people to not make decisions.
Well articulated. So that's what I was trying to say in a nutshell. But let's get right into it. So interest rates are in the high fives, and right now there's a strategy for interest rate buy downs. And really, in all simplicity, it's the fact that you can apply money or funds towards the interest rate being less than what you're qualified to get for that program. Is that right?
Essentially, yeah.
Yeah. So I know on our last couple meetings ago, you had put an example of a flyer together for me, and you had an example of a loan at the purchase price of $490 or something like that, and if there was a $10,000 contribution to the interest rate buy down from either the seller or the buyer, that interest rate would come down from like 5.75 to 4.99 or something like that, almost a point.
Yeah, 7/8 of a point. In that example, we were using a $10,000 seller contribution to buy the rate down 7/8 of a point on a $490,000 purchase with 20% down for a primary residence. And in that particular instance, it brought the rate down 7/8 of a point to 4.99%. Every situation is going to vary depending on where we are in that particular coupon stack on that particular loan on any particular day. But in that situation, that's what it bought it down. It saved the client, I believe, $217 on their payment. So that's an instance where you can ask the seller to contribute that money towards your closing costs, and then you can use that money to buy your rate down. In that instance, that is a permanent buy down, where your rate for all 30 years, instead of being 5.75%, will be 4.99%. That's one way to buy your rate down if you're looking for a permanent rate buy down. There's other programs where you can buy your rate down only for a limited time period, with the expectation that you won't have that loan for that long, and you'll be able to refinance your loan into a lower rate at a future date, for example. So there's instances of that I can explain as well.
Oh, cool! I didn't know about that flex program.
Yeah.
So that's nice to know about. So, if you're a buyer and considering entering the buyer's market, or already in the buyer's market, and you're concerned about the current interest rate and which affects your mortgage payment and mortgage amount, you can buy it down. And being that we're in a different market where there's more negotiations going on, one tactic is have your realtor, keyword have your realtor, start entering negotiations with that seller. And if that's the main thing, more than cost of the property or anything like that, if it's the interest rate and the payment, there's ways to negotiate that into your deal. So talk to your realtor and your lender about that. Right now, like it's not so much the price that are scaring or shocking people. It really is that interest rate more than so, because it was proven that, you know, the last few months prior to interest rates being too crazy, that buyers were all over the place, you know, happily taking down these prices. So I think more than the price, it is the interest rate that is the concern.
Yeah, there's an affordability. It's the affordability index. It's a combination of the fact that, you know, there's been appreciation consistently over the past really 10 years, and we've hit a point now where the houses have appreciated a lot, and then you combine that with the rapid increase in interest rates. We've gone up, 2.5, almost 3 full percent in a very limited time period, about a 6-month time period. And so just the overall cost of housing has increased. And so people are starting to look at that saying, is this the correct time for me to buy? So it's different for every client, their situation. There's just a lot of different combinations of fact patterns, and everybody's different. So you have to have a consultation with your realtor and with your lender to really figure out what the best combination of all those things is for you. There isn't a blanket answer to all those things. No,
it's I know it's case by case based on that specific place that individual is in at that time.
Yeah.
And their overall scenario. Like on a macro level, I question why, like, our interest rates getting that low was artificially caused by the Fed buying bonds. Is that right?
Well, that was one of the things that contributed to it. Yeah.
One of the things.
Yeah.
So I question why they felt it was necessary to bring it down into the 3.2. Not that I'm complaining, because I bought it or refinanced during that time, but I question why they had to go so low. Now the correction is pretty major to catch up.
Yeah, that seems to be somewhat of a pattern with our monetary policy and our fiscal policy. They sort of overdo it.
I know, me as a buyer, I mean, like, I'm still buying at 4s, right? And
yeah, they purchased over $4 trillion worth of...
But why all at once? Like, couldn't they have just trickled down and bring the interest rates to like 4s and low 5 and everybody's happy?
It's a good question.
I mean, instead
Sure, anybody
they gave
has an
everyone
answer.
the golden egg, and 2 and 3s, and now
Yeah.
now the correction is pretty major.
Yeah, I don't disagree.
Okay, well,
I'm not sure I have a good answer
well,
for
putting
it.
you on the spot, right?
But
of course.
yeah, I mean, that is the thing that they're going to have to deal with. The fact that they purchased over $4 trillion worth of securities, treasuries, mortgage-backed securities that artificially kept rates low for an extended period of time, and kept our economy very, very hot for a very long time. And now we're having to unwind that, and it's going to be a somewhat painful process.
Well, buyers, you heard it. I mean, you can buy it on your interest rate to get a better interest rate. There are limitations to it, which I'll let Dax get into because that's not my department. And then, on another note, like you can negotiate that into the resale market, but consult your realtor because you can also do this with the brand new home sales market. There is some potential negotiating to do there, or I see that they're offering more incentives for multiple reasons. But the point is that you can potentially get your interest rate bought down by the seller. Now, if you can't get it by the seller, of course, you as the buyer can contribute money towards it and buy it down. And a good lender such as Dax or whatever you're using can compare the break-even analysis to see if it's even worth the amount of upfront money to buy down that interest rate, and find out what your break-even over time is and see if it's worth it. Is that an accurate statement?
Yeah, that's one of the things that we go through, and we're trying to determine the best use of your funds. We determine how long it's likely that you're going to have that loan, either stay in the home or have that loan, and then using those funds to buy down the rate. How long are you going to be saving that money? So if you save, in this instance, $217 a month, and you spent $10,000 to buy down that rate, how long will it take you to recoup your $10,000 at $217 a month? Now, it's a little bit more complicated, the actual calculation for that, because of the $217 that you're saving. Some of that is interest, some of it is principal that you're paying yourself back. Your own money. So we actually make the calculation based on the interest that you're paying as opposed to the principal.
Because principal goes towards your own equity, towards your own property.
So in this case, you're actually saving more than the $217. That's the cash flow number, but the interest that you're saving is in fact higher than that. So the break even is based on another number. But that's where that consultation, it's a little bit too in depth for a video like this, but we would get into that. I would explain how all that works. We could calculate the break even in the number of months.
Too in depth for me?
Well, I just think when I go through this with clients, I use charts and I use explanations.
I do the same for my clients.
Yeah.
We get into
because it's pulling numbers out of the sky. It's difficult to envision exactly what's happening.
I'm just messing you. We go down the same rabbit hole. I get it on a one-on-one basis.
Yeah. But just know that we make that calculation to determine what's really best, the most efficient use of their money. And all buy downs aren't equal. You can buy down your rate, for example. The first quarter point you buy down your rate might cost a certain amount of money. Say it may cost you, say, $3,000 to buy down your rate from 5.75 to 5.5. But then the next eighth might cost you only $1,000, for example. And it's more efficient to take that next eighth of a point. So you'll want to do that. But then the next eighth may cost you $2,500 because they're not all equal. So, and it changes all the time. It changes every day.
It's critical to get a professional to consult you, because this is true. The dynamics change, and all of this will affect you differently. And just the fact of getting your interest rate less is not always the right answer. It's really what you're trying to accomplish, right? For example, it might be even a better strategy if you think the interest rates, based on whoever is consulting you, thinks where interest rates are going, and a lot of professionals think interest rates are going to get better in the future. So it might be even a better strategy, rather than to buy it down now and use X amount of money up front to buy it down now. It might be a better strategy, depending on your situation, to just use whatever the conforming rate is now, or whatever the rate is now, and then maybe refinance in 2 years, 3 years, when interest rates potentially get better. So that might be another strategy.
You could use that money towards your closing costs and just keep your rate the same, so that you're not coming out of pocket with the closing costs. Another way to do that is what's called a 2-1 buy down.
And guys, before we get into that, closing costs are averaging about 3%, a little bit more for FHA, I believe, but normally averaging about 3%. And it includes escrow fees,
title, escrow,
insurance,
appraisal, underwriting, processing. It includes your soft costs as well, which are your upfront taxes and insurance. All that's rolled into those closing
prorations.
costs.
So that's all your closing costs. So what Dax is saying, instead of using the money towards buying down your interest rate, you can use it to lessen your out-of-pocket expense, which is your closing cost, or down payment, which is kind of one and the same because they both come from your pocket. But there's different ways to allocate your money. But looking at the end game on how long you're going to hold that loan, where you think interest rates will be, will probably dictate the decision that you make whether or what is the best strategy for buying today, right?
Yeah. And that's where, the buy downs it all depends on somebody's personal situation. If somebody wants to buy down their rate and have a lower rate just for example, the first 2 years of their loan, and then go back up to the rate that they would otherwise have today, that can be a very effective way to go about it too. That's called a 2-1 buy down, where if the rate was going to be 5.75%, for example, today, they'll get a 3.75 rate for the first 12 months, then they'll get a 4.875 rate for the next 12 months, and then it will become 5.75 3 years or 2 years from now.
So that's another way to play the market.
You got it.
If you think it's
If
coming
you
down.
think rates are coming down, and it's very likely that you'll end up refinancing that loan within 2 years, which I think is.
And most professionals think.
And I think that is a good probability that you'll end up in
Worded.
that you'll end up in a loan that will be low with a lower interest rate than you do today. And if you're willing to take that, if you believe in that probability, that's a good way to go to use that buy down. Another factor in all that is, where is somebody's income? Where, what are they using to pay that mortgage back today? Where their income be? For example, if they need a better cash flow today, but they won't need as much cash flow in the future, because they'll have another person contributing towards that mortgage, or they know they're going to be making more money due to a raise that they have contractually obligated in 12 months or 18 months, but they'd rather have a lower payment by $400 or $500 this year, but they don't need it next year. Great use of a 2-1 buy down. Or the opposite could be true. So planning out what their income sources are, all those things can have an effect. Or somebody who's going to be receiving a Social Security benefit next year, that's going to be adding to their income that they don't have this year, or an annuity, or some other type of fixed income that that they're going to have in the future that isn't there now. All these things will contribute toward the decision on how they want to go about using those funds.
And that's kind of like what we're really getting at. And even for the real estate side, it's not a simple yes, that's a good idea answer.
Yep.
Right? It really comes down to your scenario and the property and the timing. There's a lot of factors.
And this is where the consultation about what is best for any individual client comes into effect. And that's why I like to, with all my clients, we have an initial consultation, and that can last anywhere between 15 minutes and 45 minutes. And we go through all of these things to make sure that the deal is being structured appropriately for them. They're making an offer and using that is appropriate for them. They're using the funds. They're asking for things that are going to benefit them.
Well, I'll put a plug in for you, Dak. A lot of lenders, loan originators, what they'll do is, they'll plug in an application to the whatever system it is, get back, this is the best loan for your client, and they'll draft a pre-qualification, pre-approval letter based on that computer algorithm, and not looking at the overall picture and this consulting we just talked about. Is that right?
Yeah, that's absolutely true. I mean, there's a lot of mortgage business models that are based solely on that. It's really just taking in information and spitting out whatever the computer says to do. And there's really no consulting going on there, and there's nothing outside of the box. There's just a computer-based model.
Not all lenders are created equal, and I guess that would be the difference between, like going online for some computer-generated loan qualification versus consulting with someone who understands the overall picture.
Yep.
So that's all great info. I hope you guys are getting value by watching this. And on the flip side, first of all, we've been talking about buyers. On the flip side, how this benefits a seller is that if you're in the market selling your property, and I'm sure, If you aren't getting the engagement, which leads to viewings, which leads to offers, which leads to escrow, which leads to closing, if you're not getting that in that order, you're a little bit worried. And I was just telling some of my sellers, hey, they're asking me what are we gonna do, and they expect me to come up with those answers. So we talk about similar scenarios that Dax had talked about with the loan side on the real estate side of things, and we talk about different strategies. And a lot of agents will just say simply reduce the price, and that's not always the right answer, guys. It really depends on the situation, and it also depends on the seller's time constraints and pressures and goals. So with that, I'll give you a scenario, and we just brought this up in our meeting. You have a listing out there, it's floating for 30 days, seller, you're starting to get a little nervous as the market corrects or is twisting and turning, and the question comes up, should we do a price reduction? And again, that's not always the right answer, because it's based on what's going on in Las Vegas at that time and what's going on with your community. And if I were to do an analysis on your community, and you knew that there's properties that are equal to yours listed less than yours, and it ain't selling either, or there's hardly any sales in your community, I don't think price is going to sell your property, right? The one thing that the price change will do is potentially re-optimize the listing for all the different websites, and bringing it up to search engines and all that, because a change was done. But as far as the price itself, you might as well change it $1 to get that same algorithm change and optimize your listings, because obviously it's not price that's selling those houses. And so maybe there's different strategies, and this is where those interest rate buy downs come in. And for example, if you're fielding the calls or doing open houses, and you know that the buyer that's potentially interested in your property is not pulling the trigger because they're worried about current interest rates and their mortgage payment, that's where, as a seller, you can offer an interest rate buy down or an interest credit rather than reducing price, right? And so, for example, in the scenario we talked about in the beginning of this episode, we talked about $10,000 buying down 7/8 of a point or whatever it is. You can offer $10,000 credit versus a $10,000 reduction or negotiation, or do it upfront, and we advertise that, use that as an advertising marketing campaign, saying that there's a X amount of credit towards interest rate buy down, and we can get you down to almost a point less, making your mortgage point less, and making you feel good as a buyer. Because what I know to be true is that it's not, again, the price that is scaring people right now, buyers, it is the interest rate. And so that's how we could combat the feeling of, I don't know what to do, or I'm scared because interest rates are higher. So that's a good nugget, hopefully, that can help you listing agents or sellers with some different strategies. And we can throw it out through social media, we can throw it out to postcards in the community, we can target market our buyers, it's called geofencing, and put that program out there. So that's the kind of outside the box we're doing as listing agents, trying to get these properties to sell, and helping our listings sell. Now, as far as the dynamics to the loan, if you look over an amortized schedule, and say it was a forever home for me and I was the buyer, and I wanted to purchase a home, if you looked at the amortization of 1 point over 30 years, it's going to be a lot of money based on the purchase price. So to me, mathematically, it immediately would make sense to, if the savings is 150 grand over 30 years, and it's going to cost me 25 grand, 30 grand to buy it down for that savings over that manner of time, and I know I'm going to keep it that amount of time, then it would make sense to buy it down up front. But I know there's restrictions to how much you can buy it down. Is
Sure.
that right? So
Yeah, there's only so much efficiency in those buy downs. And then the next question is how, it's not how long you're going to keep the house, it's how long you're going to keep the loan.
Correct. Right.
And
Thank you for clarifying.
you have to figure out where you are in the economic cycle and where you are in the interest rate cycle. And it's most people's belief that we are at the high end of an interest rate cycle right now. And
well, that's good news.
Yeah, I tend to believe that as well. And people who are doing loans right now and getting an interest rate of 5.75, you look at it and you say, what is the probability that I'm going to have this loan 5 years from now, 3 years from now, 5 years from now, 10 years from now? So if you look at it and you say, the probability of me having this loan, whether it be because I don't have the house anymore or I've refinanced it for whatever reason,
paid it off,
to take cash out, to refinance it to a lower rate, or any of those those reasons. So if you spend money for a buy down and it takes you, say, 3 years or 4 years or 5 years, and sometimes it can take longer than that depending on the actual loan, to break even on the amount of money you spent, and it takes you, let's just say, 5 years to break even before you're actually making your money back. You say, well, the chances that I'm even going to have this loan.
Well, you've already made your money back, but realizing the savings. Right?
Yeah. So that's where you have to figure that out. And the answer for most people is, it's not likely that I'll have this loan 5 years from now for any one of those reasons. I'll take cash out, I'll refinance it, I'll sell my home, whatever the case is. So you have to figure out, whether or not the buy down makes sense for you and what you're trying to achieve with that goal. Which is why the 2-for-1 buy down, I think, is a really effective tool in this market, because you get an interest rate buy down.
So explain 2-for-1.
That's you get 2% to 1 buy down. You get a 2% buy down on the interest rate in the first year, and then 1% in the year after that, and then it goes back to the normal rate in the third year.
That's that flex program I called it.
Yeah. So if rates are 5.75 today, let's just use that as the going 30-year fixed rate right now. You get 3.75% rate the day you close, and it will stay that way for 1 year, and then it's 4.75 the year after that, and then goes to 5.75. So you're realizing a benefit, and you're lowering your payment and your rate dramatically right out of the box. But you're not taking any kind of long-term bet that you're not going to, you're going to be wasting your money on an interest rate that buy down that you're not necessarily going to realize the effect of.
Might be perfect for someone from California, Hawaii, Washington that's relocating here, that's unsure about the environment, but need to live somewhere. They don't want to rent, so they want to buy. That might be the perfect scenario.
I think it's a really good option for a lot of people right now. I think it could fit many scenarios.
Cool. All right. So there you go.
And if you get the seller to pay for that through their seller contribution,
bonus.
I mean, you're in really good shape.
Yeah, and that's the benefit, to buyers anyway in today's market. We just talked about that. Like, there's multiple reasons why this market does benefit buyers in different ways, although it doesn't feel that way. Now we're getting through FHA, VA buyers, we're getting contingent on sales offers accepted, we get to negotiate things like this, and we're not settling for a home, we're picking a home that we really want as a buyer. In the past, we compete with 40 offers, 30 offers.
So go out, find
the house. We settle for what we could get.
Get the house you want, negotiate a great price on it, and if use seller contributions to buy the rate down to yesterday's rate, and you're in a really good position.
Now, what are the limitations to the buy down? I know appraisal was an issue, and initially, last episode we talked about how we have to worry about appraisal, because if we're asking for a contribution, it still has to appraise, or someone's coming out of pocket, which kind of defeats the purpose. So you said there's a way that we don't have to worry about that appraisal concern.
Sure. So it depends on their overall loan to value.
Well, first of all, I'm sorry, Dax, to cut you off. Let's make this very, very transparent and clear to everyone what we're talking about. So anytime you get a loan, the lender requires an appraisal. And sorry guys, but the appraisal isn't really to protect you guys, although it does. The appraisal is done to protect the lender from over-lending to you and mitigating risk. So based on that, the appraisal has to appraise in order for you to get the full loan ratio that you were looking for, right? So if you buy a house at 500 grand, for example, and you're putting 10% down to make it an easy number, it has to appraise for 500 grand. If it appraises for 450 grand, your loan amount will be much less, and someone would have to come out of pocket the $50,000 of deficiency.
Yeah, the loan amount, the 10% will be based on the lower of the appraised value or the purchase price. So they'll actually, it'll be 10% of the difference. So the way you combat that, the formulas for how all that work can get a little bit complicated to explain. But at the end of the day, you need the house to appraise for whatever it is you're selling it for.
Or buying it for.
But buying it for, I suppose. But if in a scenario, for example, where you're putting 20% down and you want to avoid the mortgage insurance, which is typically, is a very common scenario. And let's just say in that scenario, it's a $500,000 home. They want to put 20% down, so they're going to put $100,000 down. They're going to have a $400,000 loan. But let's say for whatever reason, it doesn't appraise because perhaps the seller decided to contribute towards closing costs, and they still wanted to net what they wanted to net for their home, and it doesn't appraise. Let's say it came in $10,000 less or $5,000 less, something to that effect. We can still make that work with a lower appraised value and avoid, and we'll have a mortgage insurance policy on that, because it has less. You're in that 85 to between the 85 and
It's less than
80%.
20%.
Yeah, 85 and 80% bracket. Anywhere in that bracket, you're going to have a mortgage insurance policy. But what you can do in that
So
case,
anywhere less than 20% down.
yeah, but they go in 5% increments. So it's 5% down, 10% down, 15% down. So you would be in that 15 to 20% bracket, anywhere in that price range. You then have a mortgage insurance policy, but there's two ways you can handle mortgage insurance. You can handle it either through a monthly payment, which is the way most people choose to do it. So you might have a $50 a month mortgage insurance payment, but you can also do something else. You can do an upfront mortgage insurance policy, and you pay it all out of pocket up front. So in that case, you can just eliminate it by paying, say, a $2,000, $3,000, $4,000 and just get rid of it entirely. So you can use part of your seller contribution, or you can pay it out of pocket up front and just eliminate it entirely. So you can use a combination of whatever they're giving you to offset that, and then use your buy down in combination with that and get rid of it, or you just come out of pocket the money, and then you don't have to worry about it any longer.
So that can sound a little complicated, but really what Dax is saying is that anytime you put down less than 20% on a purchase, most lenders require mortgage insurance, and mortgage insurance is an insurance protecting the lender from the buyer defaulting because there's not enough skin in the game for that lender to feel comfortable with.
Correct.
And so anytime it's less than 20% is what Dax is referring to as far as down payment. There's a way to offset that mortgage insurance, which is normally a monthly payment out of pocket.
That's the way most people choose. You can do it all up front and just get rid of the mortgage insurance through one big premium, or you can pay it monthly and then eliminate it in the future when you have enough equity in the property. Now, that's not always the case. If you're putting down, say, 25 or 30%, and the house doesn't appraise, that's fine too. You're not going to have a mortgage insurance payment. You're just going to apply some of that money. And if you were putting down 30%, then it's effectively you're going to end up putting down 27 or 28% instead of the full 30%. So there's ways around that, and so you don't really have to worry about that. We can overcome that through a bunch of different strategies.
I guess so that makes sense. Now, if you're not completely understanding it, don't worry about it, because this is something that your lender, in collaboration with your agent, should be able to handle and articulate on your deal. All you need to understand is that you can buy down the interest rate, and if it doesn't appraise, there's other options and solutions potentially. Yep. So don't worry about understanding all of that. Just understand you can bring your interest rate down, you can have the seller pay for it, or you can pay for it. And again, if your property doesn't appraise for that offer or accepted price, there's ways to deal with the consequences to that.
And there's also instances where you don't need an appraisal at all. In many cases,
yeah, I've seen a lot of that with your
there's been a lot of appraisal waivers given. They're not as common today as they were a year or two ago, but they're still we still frequently get them, especially with 20% down, high 20+% down and high credit scores, conventional conforming loan amounts, we get appraisal waivers where we don't even need them at all.
So as I was saying, appraisals are really to protect the lender from overlending or mitigating risk, and many times because the risk is minimal based on the strength of the buyer or the amount of down payment or the confidence in the purchase price and market, the lender is willing to waive the appraisal in its entirety, and so that's a huge benefit, savings in the appraisal cost and concern about that. And I've seen it happen a lot of the time when buyers come to the table with heavy down payments. Obviously,
Yeah.
they have more skin.
It really has to do with when we run them through automated underwriting systems, either through Fannie Mae or Freddie Mac, and when in these neighborhoods, especially in Las Vegas, the neighborhoods are there's a lot of other model matches, and if Fannie Mae looks into their database, for example, and they see they've done a lot of other homes, and they have a lot of data about those homes and valuations, they can look back in there and they see what's going on. They have confidence that that the valuation that we're using in there is in line with what they're seeing with the rest of the data that they have for other loans in that area. They'll waive the appraisal.
That's good data. So I hope you guys got that. If you have any questions, reach out to Dax, reach out to your lender, reach out to myself, reach out to your realtor, whatever you feel comfortable with. Get the answer so you understand that, because all these decisions and options in order for you to make decisions is critical to you making the good decision that you should buying one of the largest purchases that you may be purchasing in your entire life. So just understand that there are people out there that have the information and the data and there to figure out how to use that data to best serve you. Again, if you have any other questions, Dax Tobin from Millenium Mortgage, Randy Hatada, Xpand Realty, just comment below. And if you liked what you saw, like the episode, hopefully you subscribe to my YouTube channel. I think Dax is gonna be setting one up soon. Highly recommended, Dax, because our consumers need this information out there. And it doesn't matter if it's coming from me, Dax, or your realtor, or whoever it's coming from. The important thing is that the consumers knows get and understand what's really going on, and don't get a skewed sense of what's happening today. Because I see a lot of that just happening, and I really think that our drastic market change had to do a lot with consumers just figuring things out. And I think our buyers especially are still at that stalemate where I'm not sure what to do moment. And until they do, the market will continue to correct or be at a standstill, with probably inventory climbing. In general, I think this whole correction, well, obviously it's temporary, but for how long? I don't think it's going to be as long as people think. I think we're not out of the woods yet. I think things might get worse before it gets better. But again, this is opinion, this part of it, and make sure you're getting your data from someone who really understands what's really going on. Anything else that you'd like to add?
I think we covered it.
Yeah. That's a...
Yeah, I mean, I would stress that everybody's situation is individual, and tiny little differences in the way your finances, the way your life is, and your family can make a big difference in how you go about structuring your loan, your finances, what is appropriate for you and your situation, when you want to move, how you want to move, how you go about all that stuff. Can make a big difference. So that's where you really need a good consultation, and you need to be working with professionals who can guide you in the proper way for your situation. And
that's why I have a problem with people putting out there, this is the perfect time to buy, worst time to buy, and all that, because they're not taking the individual into account and the situation.
The perfect time for one person could be the absolute wrong time for somebody else, with a nearly identical fact pattern, and one tiny difference can make all the difference.
Right. And just like every individual has a fingerprint, every situation has has its own identity, and you have to just figure it out. Thank you guys. Again, we'll see you soon on the next episode. Take care.